Good afternoon, everyone, and hello. Welcome to today's session of Jakarta Property Watch, a webinar presented by Colliers Indonesia. We will be covering the latest updates and forecasts for the property market in the first half of 2023. Before we begin the webinar, we would like to share some important information about today's session. The audio and video of this webinar will be disabled, especially for the participants, to minimize background noises. Only the speakers giving the presentation will be allowed to enable their audio and video. And please note that this webinar is being recorded, and we will share the recording file and presentation slides tomorrow morning. At the end of the webinar, we will conduct a Q&A session, so feel free to type your questions in the designated question box. If you encounter any issues or need assistance during the webinar, please do not hesitate to type your questions in the chat box, and our webinar host will help you. Tomorrow, along with the recorded version, we will also send a survey link for you to provide your feedback, and we appreciate if you can take your time to fill out the form. To kickstart our webinar session, it is my pleasure to introduce you to the esteemed experts from Colliers Indonesia who will be speaking today. Firstly, we have our Managing Director, Bapak Mike Broomell, who will be delivering the keynote speech to open the session. Following his presentation, we will have a series of insightful talks by our other experts. For investment market, we will have Bapak Steve Atherton and Ibu Monica Koesnovagrill. For hospitality services, we have Bapak Satria. For office market, we have Bapak Bagus Adikusumo. For retail sector, we have Bapak Halsema. For industrial and logistic services, we have Bapak Rivan Munansa. And for residential services or expatriate housing, we have Ibu Lenny Es-sinaga. Bapak Steve Atherton will also cover our apartment sector. So without further ado, let's give a warm welcome to our keynote speaker, Bapak Mike Broomell. The floor is yours, Pak Mike.
Thank you, Auntie. Good afternoon, everyone, and welcome to our first webinar of the year. It's great to see many familiar names joining our webinar session today. We appreciate you taking time to hear from our experts about their findings and insights on the real estate market in the first half of 2023. Looking at the property investment in Indonesia, we've witnessed continued strong interest from local investors, despite the global economic challenges in other countries. In today's environment, regional and global players have taken a back seat, while domestic investors and developers are the most active participants. Colliers has also noticed an increasing interest by developers and investors in non-traditional alternate types of property or asset classes. Our experts will further explain what those particular asset classes are later in the seminar. This year, the healthiest sectors are once again industrial, logistics, data centers, and increasingly hospitality. The industrial logistics sector has benefited from the growth of the electronic vehicle market, as you may well know. Data centers continue to be built to meet the current and anticipated explosion in the digital economy, including AI. Finally, hospitality has rebounded with the uptick in foreign and domestic tourism. We also have seen encouraging signs of renewal in the retail and even in some cases in the office and apartment sectors. We hope you enjoyed today's webinar, and we look forward to staying in touch with you. If you have any questions, please don't hesitate to reach out to me or any of my colleagues so we can discuss how we can assist you. Thank you very much.
Thank you, Pak Mike, for the speech. We're moving to the first sector today, which is the property investment. And please join me in welcoming our esteemed experts, Bapak Steve Atherton and Ibu Monica Koesnovagrill, who will be sharing their valuable insights today. Pak Steve and Ibu Monica, over to you.
Thanks, Auntie. Good afternoon. What is happening currently in the global landscape is that some of the largest property players in the world, like Brookfield, Blackstone, Goldman Sachs, are handing back some of their largest properties, especially office buildings, to lenders. No one knows the exact number, but somewhere in the range of 500 billion US to 1 trillion is expected amount of reduced value in the office property market sector alone in the USA. This current instability is primarily due to the reduced office demand, the layoffs in the tech industry and other industries, as well as the rising interest rates. Uncertainty around how to fill or reutilize as much as 30 to 40% of the vacant office space in the US is presenting a tidal wave of fear and pending losses. So I guess if this is what it feels like to be right in the middle of the storm of disruption in the global commercial and residential property markets, then Indonesia, Greater Jakarta in particular, are not doing too bad. We have our challenges in the office market and the apartment markets here, but we aren't adopting the current Survive to 2025 slogan that US developers and property owners are holding on to these days. However, while Indonesia is not immune to this global disruption in property occupancy and value losses, we still are impacted. Regional and global investors and developers are mostly focusing on their existing portfolios in the primary gateway markets and managing their higher costs of ownership due to higher interest rates, and in some cases, reduced demand, and trying to find to successful exits in their current investments. This focus on preserving portfolio values outside of Indonesia also means investors are less ready to deploy fresh capital in developing markets like Indonesia. Some private equity investors are increasingly offering to provide debt rather than equity, resulting in available loan capital with stringent underwriting criteria. For equity deals, the fewer foreign investors are almost all gravitating to safety. This means learning the market and finding the right partners in asset classes like land and housing, logistics, data centers, and some alternative investments like senior living, healthcare, and student housing. With the regional and global players playing less of a critical role in the environment today, the local investors and developers are the most active. With landed housing and township development positioned as the strongest asset class at present, the biggest local developers like Ciputra, Sumeracon, Astraland, Intiland, Alam Sutra, and Sinar Mas Land continue to buy new land or develop existing land banks with new clusters and projects. In some cases, they are developing 100% on their own, and in others, they are partnering with foreign JV groups like we see in Mitsubishi Corp and Serbana Jurong with their entity Mitbana, through new JVs with groups like Sinar Mas in BSD for their 107-hectare township, and with Intiland on their 51-hectare project at Telaga Bestari, a residential district in Tangerang. But landed housing is not only for the big and strong. There are plenty of tiers of housing in different sizes and prices being sponsored by local developers of various size, including small and medium players. Some are specializing in subsidized landed housing, which remains healthy with reasonable profit margins and government support for loan subsidies, while others tend to stick to their areas like under 500 million, under $1 billion or 2 billion, or even 4 to 6 billion and higher. This asset class continues to perform well, and JV partners are interested to do more deals in this area. With the e-commerce market slowing down compared to the massive amount of buying during COVID, we see some adjustment in the logistics space demand by these companies. E-commerce are still there, but demanding less space. And we still have the FMCG demand, the third-party logistic companies, and others. The primary markets remain in the Eastern Industrial Corridor, but some companies are seeking new warehouse facilities in the South and the North and the West. Ability to find land at reasonable prices remains the biggest challenge in launching new projects. There was a new JV deal announced recently between ESR, one of the top Asia-based logistic developers, and their new JV partners, including INA, the Indonesian sovereign fund, Mitsubishi Corporation. The venture is investing in 3 strategically located modern logistic parks in the Eastern Corridor, developed and managed by ESR, and the partners are exploring committing to additional joint investments in the sector. There are also other foreign and local investors interested to join existing players and co-invest in existing industrial portfolios or build new development platforms with experienced local players. This space remains one of the most resilient. The other asset class that continues to show active demand and growth is data centers. While there are few investors or traditional developers actively buying land in the CBD or the fringe CBD today, the DC players remain one of the only games in town. For the data center investors, the locations to develop will typically be either east in the industrial states or closer to the customers in the city. Outside of the industrial zones, we're seeing new data centers being developed in places like Dan Mogot, Sentul, MT Haryono, Gatot Subroto, and Kuningan. And as we speak, there are more edge data center players entering the market and buying land in the CBD and the fringe areas. While the amount of capital required to invest in the data center space is huge and the expertise is quite specialized, there remain a number of local and foreign investors seeking opportunities in this asset class. Aside from these favorites, there remain challenges for investment in the office sector and apartment sector. While there is tenant activity and leasing deals getting done in the office market, the risk and reward equation is not yet healthy for fresh investment in existing buildings or new construction. The reason for the lower interest is the high office vacancy rates, the lower rents, lending hurdles, and uncertainty around the recovery to a new normal. There's also the usual problem of bid-ask spread that is too large to bridge. By the way, the bid-ask spread is now one of the main reasons transactions also aren't getting executed in other major gateway markets around Asia, North America, and Europe. Retail and hotel are rising back, but still not completely performing at the economic level of pre-COVID. Retail tends to be quite specialized, and many of the big retail players, local and foreign, already have their fill of retail malls. So the appetite to deploy fresh capital into more retail is less. Some exceptions remain for players like Eon Mall and a few cash-rich local developers. For hotels, we have not witnessed much investment activity in the greater Jakarta area. There are some individual hotels and small portfolio deals currently on offer, but the returns are hit and miss, and investors are typically looking for strategic deals with healthy upside, which are hard to find. The most interesting hotel market remains Bali, and the demand also extends to villas and branded residences. We have seen some significant land deals in recent months in Bali, and some for-sale villa resort developers and cluster developers have been achieving excellent results in the last 2 to 3 years. We expect Bali will continue to perform well and broaden the amount and variety of investment products. I will address the apartment market in my other talk today. Thank you for your time. Over to you, Monica.
Thank you, Pak Steve. Thank you, everybody, for joining our today's webinar. So this first slide shows type of projects that conducted by advisory services Colliers Indonesia during 2019 to 2022, which in certain extent could reflect investors' interest in property development. Mixed-use development, showed in dark blue, was the most attractive sector for investors in property development in Indonesia during the period, for the exception in 2021. Office sector, showed in gray, had been the lease assignment since 2019 due to tight market competition. Apartment, showed in light blue in 2019, was still popular assignment from investors. Yet, its popularity became lesser and lesser. On contrary, landed houses assignment in lighter blue became more and more popular. And in addition to landed houses, type of sector that became more and more popular after the pandemic are logistics or warehouses in red, industrial estate in light yellow, and TOD in yellow. We also find some unique or niche markets for dormitory and also for senior living. Next slide, please. This chart shows the breakdown of investment sectors in Indonesia in 2022. In line with Colliers data, 14% of domestic investment was in transportation, warehouse, and telecommunication in dark blue pie, and 12% in housing, industrial estate, and office building in gray pie. The percentage of both sectors in foreign investment was lower, 9% in transportation, warehouse, and telecommunication in blue pie, and 7% in housing, industrial estate, and office building in light blue pie. Next slide, please. This chart shows the area of interest for property development based on work done by Colliers. Jakarta and Bodetabek are still the most preferred location by investors for property development. About 50% assignments were taken place in Jabodetabek. An interesting fact was that Central Java became more and more popular due to massive infrastructure development. Kalimantan, especially East Kalimantan, started to become the area of interest, mainly due to the development of the new capital city, Nusantara. Next slide, please. This chart shows the breakdown of investment area in Indonesia in 2022. In line also with Colliers data, 37% of domestic investment was still in Jakarta, West Java, and Banten, includes or cover Jabodetabek. East Kalimantan and Central Java contributed 6% and 4% domestic investment share. For foreign investment, 30% investment was taken place in Jakarta, West Java, and Banten. Central Java and Kalimantan accommodated 5% and 2% of foreign investment. Next slide, please. Within this year, LRT Jabodebek will start its operation to connect Jakarta to Cibubur, showed in black line, and to Bekasi, showed in red line. Connecting Jakarta from its satellite areas, LRT Jabodebek is expected to trigger off the TOD along the line. Next slide, please. In addition to LRT, another major infrastructure development, Jakarta-Bandung high-speed train, will also start its operation within 2023, connecting Jakarta to Bandung through the industrial epicentrum in Jakarta and West Java. It is expected that this route will also trigger off the development of TOD. However, taking into account the distance and connectivity to Jakarta, it is expected that TOD along the LRT Jabodebek will occur faster. Next slide, please. So, in conclusion, based on our data, there are several sectors of interest for the last 2 to 3 years, namely industrial estate, including logistics, data center, and cold storage, especially towards West Java and Central Java, and also housing, including dormitory and co-living, and also senior living, in addition to the normal landed houses or the traditional landed houses. So thank you for listening. Back to you, Auntie.
Thank you, Ibu Monica. And thank you also, Pasti, for the explanation on property investment landscape in Indonesia. We're moving to the first sector today, hospitality sector. Allow me to present Bapak Satria Way, our distinguished expert in the hospitality sector, who will be shedding light on the key aspects of hospitality sector today. Pak Satria joining from Bali. Over to you, Pak.
Good afternoon, everyone. Thank you very much, Santi. Yeah, it's a nice, exciting moment actually for the hospitality in Indonesia. If we see the improvement of the hotel performance in 3 major cities, we have Jakarta, Surabaya, and Bali. Actually, we are in a 2018 and 2019, which is Bali is already override everything with the volume. So currently, Bali is already on the top of the market, continued by Jakarta and Surabaya. If we see the occupancy in 2023 with the data that we have been collected since January until May 2023, Jakarta have been achieving to the occupancy of 62%. Sorry, Bali is already in the 62% and Jakarta is 58 and followed by Surabaya. Meanwhile, the average daily rate also have been in place again accordingly, and this is even higher than what we ever since 2018. If we see the average daily rate of Bali is even higher than 2017 and 2019. In Jakarta also we are coming to the place where we are ever reached the highest average room rate of about 63 plus of US dollar per night, and followed by Surabaya. The overall actually the overall performance, not only these 3 cities in Indonesia, actually the improvement is all positive. Even though Jakarta, as usually we always affected during the Idul Fitri holiday, while everybody is going out of Jakarta, but this year also we see that Jakarta is not as quiet as before during the Idul Fitri. Meanwhile, the preparation for the president election actually is not there yet. We did not feel the impact of the president election in 2024 now, but we believe that within the 4 months to the day of election, most of the business will be picking up. While the business is enjoying the business of MICE, especially after this Idul Fitri, actually we can use our MICE facilities for 100%. Next slide, please. On the next slide, actually we are presenting what Jakarta has been enjoying for the past 5 months compared to the previous years. If we saw the occupancy in Jakarta, especially on May, and it's going to be followed by June and July, is already above most of the years, and the average while the average daily rate is not there yet, is slightly lower than before, but we are getting there. We also have a few information to show to us that during the June and July, actually the Jakarta is achieving the highest numbers on occupancy and daily rate since 2018. As we are aware that during this first semester of 2023, actually some of the Jakarta hotel is accommodating the participant of the Asian Summit of 2023. That's why the occupancy of the first semesters of this year is much better. Next slide, please. I think that the result actually we see the activities of each individual businesses and hotels. There is a few switching on the demand, on the switching on the hotel facilities that affected by the demands, especially the requisition or the demand on the family rooms, the meeting space, the open and health meeting space, and also the wellness experience in the property. That is driven by the demand of the occupiers of the hotels. Therefore, if we see there are a lot of renovation, there are a lot of new designs of new hotels. They are now accommodating most of these driver from the demands. Meanwhile, we are aware that the domestic market is still very strong, and this is the biggest power that we have. And most of the hotels, especially in the resort area, actually now trying to make sure that this domestic market won't be left behind again, because they are the one who is maintaining the occupancy and maintaining the ADR until now. The next slide. There is a lot of things that have been doing by the hotels for the past 6 months to 8 months. The one that we are monitored is there is a lot of developed and tailored strategy on sales, especially to maximize the room sales. And by doing that, actually they can earn more benefits and they can maximize the room sales. It's been done by most of the hotel operators and also the managements of the properties throughout Indonesia, not only Jakarta, Bali, and Surabaya. And the prioritizing hotel room sales technique is also been implemented. We are now in the same level of how the airline tickets is doing since year of 2000. So we are also getting advanced on doing that to make sure that the profitability is optimum. The creative tactic to increase the room sales also done by most of the properties, especially now the managements are getting more creative to make sure that they've been seen, they've been chosen by the demands, and they can make sure that they can get more market share on their properties. And this is one of the result that one of our resources providing a report that in 2023 on June actually we are Jakarta actually is enjoying the highest occupancy since 2018, and also we are also enjoying the highest daily rate during that month, and this is comparing throughout the years to 2018, and we are also enjoying the best RevPAR revenue per available room since before COVID. So this is a fact that we are enjoying right now, and this is the fact that why especially the domestic investors is now looking on this business again, even though the most of the overseas investors is still wait and see, but most of the domestic investors are already seeing this opportunity. Next slide, please. We are aware that most the MICE usage of the MICE usage in the hotels normally is between 50% to 65%, up to 35% to 80% according to the star-rated hotels. But nowadays is keeps shifting. because the demand of the office, the offline meeting are getting higher, and the increasing of the MICE activities indoor is also getting high. Therefore, the corporate MICE and also the social event for MICE is getting higher. Based on our survey in Indonesia Hotel and Restaurant Association during the election in 2010 to 2019, actually most of the period of election we are enjoying the increasing of the business for about 7 to 8%. This might happen again this year, especially from the month of November to February 2024. But it might be changed because of the disruption of the technology, and also there might be a positive disruption that there will be more and more offline meetings and activities that it might be done during these election days. The next slide. So having the increasing of the domestic market and also the demand on the facilities itself, and we already see the result that we are enjoying currently in the market. Not only Jakarta, actually even Bali also enjoying the same figure, the same enjoyment, and we are now actually able to pay our debt and so on and so forth. So this is the positive sign that the investors is seeing, especially the domestic investors, and they also since this is the moment that that we have to look into it to invest. We need to ride this wave before we are going to miss by. Thank you. Over to you, Andy.
Thank you, Pak Satria. We're moving on to the next sector, which is office. And I am delighted to introduce Bapak Bagus Adikusumo, who's been in the industry for many years, probably more than 25 years now. And he will be taking the virtual stage to present the market updates on office sector and the opportunities that's there for both landlords, developers, and also occupiers. Pak Bagus, the floor is yours.
Thank you, Auntie. Thank you, everyone, for joining our webinar today, discussing about the performance of office market in the first half of this year. The first chart here on the left is showing the supply per year from 2016 until 2025. And we expect to see two new office building completed as per the first half of this year, which is T Tower in CBD area in Gatot Subroto and Lipo Tower Holland Village in Cempaka Putih. And then we also will be able to see anticipated 4 new office building completed by the end of the year. We'll be adding about 140,000 square meter. And then as of now, on the right-hand chart here is that as per first half of 2023, we have a total of 11.1 million square meter, and mostly are located in the CBD area. And in the rest, 3.84 million in outside CBD. Now, as you can see here in the annual supply, we had a big supply 2016, 2019, but towards to the last 2 years, 24 and 25, in the next 2 years, we expect to see a more limited supply coming into the market. Next slide, please. This is about the occupancy, talking about demand for office space. The performance of the occupancy for CBD is showing a better performance than in non-CBD, 73.7% versus 72.9%. Compared to the pre-pandemic levels, the occupancy basically dropped by 11 to 12%. Now, on the right-hand side here, occupancy in the CBD by submarket, which is Tamrin, Sudirman, Rasuna Said, Mega Kuningan, Gatot Subroto, and Satria. So first half of this year, Satria shows the best performance in terms of occupancy, and then followed by Gatot Subroto, the yellow sign, and Sudirman, the blue sign. But if you're looking at occupancy as in the outside CBD area by areas, which is Central Jakarta, South, North, East, and West, East Jakarta showing the highest occupancy, followed by West and South Jakarta. If you're looking at occupancy in CBD by the grade of the building, grade A shows actually better occupancy compared to the premium. And in terms of the outside CBD, occupancy by segment or by grading, grade A shows better performance for very obvious reason. Now we expect the activity of the office after the COVID is showing an increase. A lot of company decided to have their employees come back to the office. Some are mandated, some are still applying the hybrid business model. And we have actually seen the inquiries for office space is growing in the first half of 2023. But still yet, we would like to see whether or not the inquiries for office space is ended up going into the execution of the relocation plan instead of a renewal. Next slide, please, Auntie. Now, this is the rental rate compared between CBD and non-CBD. For obvious reason, rental in CBD is higher than non-CBD, 245,000 per square meter per month versus 175,000. And then we expect that the base rental rate here, because we go by base rent and also service charge. So the asking base rent will be stable towards the end of 2023. Now, if you see on the right-hand side here, there is a sub-market. So asking base rent based on the sub-market, Sudirman shows the higher rental rate, asking rent for obvious reason, and then followed by Mega Kuningan. But on the asking base rent outside CBD, it seems like North Jakarta, South, and Central Jakarta seems to be almost similar in terms of their rent. If you're looking at asking base rent based on the building grade, for obvious reason, premium grade shows the highest asking base rent per square meter per month, followed by grade A. And the same result apply for the outside CBD by building grade, grade A, and grade B, and grade C. Now, based on this, we would like to also mention here that developers currently are focusing more on increasing occupancy rate instead of raising the rental rates. Because as I mentioned before in our webinars, that in order to have an office building running smoothly and cost-wise, developers is actually should be able to increase the occupancy rate to 70% as quickly as possible in order to have the building enough cost to run the building instead of getting the expense from the pocket by the developer. Next slide, please. Now, what are the office market present condition? What are the fact finding as per first half this year? We mentioned many times in the previous webinar that some landlords offering fit-out allowance. But in the first half, we see more and more landlords basically open to provide the fit-out allowance. Now, this fit-out allowance is not free. So it will be paid back by the tenants, amortized over the lease term. It will be paid in the terms of rental rate. So it will be in the will be added up on the rental rate per square meter per month over the lease term. Now, in terms of the sublease availability, continues to be more and more. We've seen larger space for sublease available in the market, and then we feel that it's going to continue until 2025 because many businesses are hit by the COVID and the global uncertainty, and their business is basically impacted so much. So starting for e-commerce, we see a lot of downsizing of e-commerce, startup company, tech industry. So they reduce their space very much so surplus becomes available in the market that is already oversupply. So it's quite challenging market. And then green certified office building have become mandatory as well. Use in the past webinar we mentioned is preferred. Now more and more companies basically looking for a mandatory requirement to move to a green certified office building. Again, it's part of the ESG initiative invested by each company. Next slide, please. Now we also see companies after they're making inquiries, their list is up, and they have to decide whether they renew or they relocate. After doing the exercising of relocation versus renewal, so far what we experienced in the first half, they tend to extend the list instead of relocate. Now the good thing is the state-owned companies, government companies basically is spending. They're asking their tenants to come back to the office, so they're working from office 100%. So that helps expand their requirement because they need to use the office space as people come back 100%. And some of the industries, the same industries, but different entity within government is being merged to become super holding companies. Though that helps also for the consolidation and requiring more space. But on the other hand, multinational companies, they continue to apply the hybrid business working from home and working from the office. And that ended up in downsizing their offices whenever they would like to renew. Next slide, please. Now, we have recently done a global occupier outlook reports. Now, if you would like to see the full report, you could scan the QR code here, and you can get a full report. Now, across industries, what we found is that a lot of companies, occupiers, reassessing their current office layout. They're trying to find their optimum mix in order to help understanding what the employees are looking for, the requirement and everything. So most of them are doing that. And then we also found that flex space has been very helpful for a lot of occupiers, because they provide flexibility, so companies that don't need to sign for 3 or 5 year lease, they could just take the flex space for 1 month, 2 months, 3 months based on what they need, and they can always turn it back to space without having any penalty. Now, one thing that is interesting also here is that more than 65% of workers are seeking more in-person time. So they would like to see offline their teams and discuss things directly instead of online. While 70% of workers still would like to have flexibility. So they still want to maintain hybrid, but at the same time, they also need to be offline with their teams to discuss things. Technology, digital infrastructure, and smart facilities is still the integration of those required in order to keep the tenants, to keep the customers, and also to keep a good asset of employees. Next slide, please. And another thing that we found here is that decision makers, 66% of the leader, redesigning their physical space. As mentioned early on by Steve Atherton, here is the new normal, how to adapt to a new normal. And we're also moving to a green certified building. So some of the companies, it happened also in Indonesia. We helped some of the companies, multinational, they decided to redesign their office space in order to adapt to a new normal. If they happen to be located in a non-green certified building, they decided to consider relocation as well. So those are what is going on right now. And then in order to attract and retain a good talent, making the companies to consider giving workplace solution and also new location. So if they would like to be in a CBD area, they move to CBD area, because actually timing-wise is good and then market-wise is good. And then ESG, we discussed about that also. A lot of companies investing in the ESG initiative. And then green certified building also is becoming more and more requirement. It's required for companies to move to the green certified buildings in order to, having a eco-friendly building that meet environmental, energy, and health standards in their design, construction, and performance. Next slide, please. Now, what are the trends? Now, the trend is still continue after a few previous webinars, tenants market or buyers market. So it's good time for occupiers to relocate. And then the newly operating LRT that has been recently early touched on by Monica is helping Cibubur and Bekasi, right? So the integration of LRT, MRT, busway, and commuter train will help employees, go to their office in the city area, in the CBD area. So that helps the demand for office space in CBD Jakarta. But having said that, though, we don't foresee developers will start building office building along LRT line because it's just still challenging right now. But it will when the market has come back to normal. Office market is getting better, economy-wise is good. I think developers will start building along LRT line. And then we mentioned also that company with healthy cash flow, good cash flow should buy office space. And also, if they decided to buy strata title space, then still normally they're still looking for CBD and TBS Matupang areas because it has been proven those two submarket is giving a good submarket. And then as currently office market is oversupply, and so when it's going to come back, so we feel that towards 2025, 24, 25 is going to be very limited supply, and nobody's going to build any new building to 2026 onward. So demand is still gonna grow while supply is limited. So we believe that we will be able to see a better office performance starting in 2026. That wraps up my presentation. Thank you for listening. Back to you, Auntie.
Thank you, Pak Bagus, for the presentation. We're moving on to the next sector, which is retail. And allow me to present Mr. Sander Halsema, which is our experts in the retail sector. And he is ready now to enrich us with the profound understanding on retail market in Indonesia. Over to you, Sander.
Yeah, thank you, Auntie. Good afternoon, everybody. Thank you for joining the webinar today. Before I dive into the important parameters in retail, I think in general we can say that the retail market is quite positive at the moment. In the top performing malls, we see the traffic back to normal. I think I also explained that in previous webinars. We also see retailers, especially in the F&B and the entertainment sector, expanding aggressively. They're still a bit cautious and do a proper study into where to open their new outlets. But in general, we can say they're quite aggressive at the moment. Preferred asset is malls, obviously, because of the high traffic. And we also see a lot of interest from foreign retailers still, both in the F&B sector, but also in the furniture and fashion sectors that are looking to Indonesia, either to expand to in the coming years, or they have come into this market during this year or last year. And so the Indonesia retail sector is doing quite well at the moment. Now, if we look at the annual supply, at the first 6 months of this year, there was no new supply operating in the Jakarta market. 2 new malls were opened in the Bodetabek market. Karsten malls in Tangerang and Cibinong City Mall 2 in Bogor were opened. Towards the end of this year, we do expect some new supply also in Jakarta to open up. An example is Agora at Tambayan 9. It's a lifestyle center of 45,000 square meters, really focusing on what the consumers nowadays are looking for. So really focusing on F&B and entertainment. If we look at the total supply in the market, in Jakarta, we have about 4.9 million square meters of modern retail space at the moment. In Bodetabek, it's close to 3 million square meters. And also going forward in the coming years, we see most of the new supply coming onto the market in the Bodetabek markets, and mainly in Tangerang and Bekasi. They will become the largest regions for new mall supply in the Bodetabek areas. Next slide, please. Now, if we look at the occupancy rate in Jakarta, it's 72.5%. In the Bodetabek area, it's about 70%. Now, obviously, these are averages. So if you look at the submarkets, you can imagine the occupancy in CBD is the highest. This is where most major malls are located. And in the Bodetabek area, the malls in occupancy in Bekasi mainly is above 75%. So those are performing quite well in terms of the occupancy. If you're looking at the different mall grades, you can see that the premium and the middle upper malls are performing very well. All have high occupancy rates, both in Jakarta and the Bodetabek area. And the malls, and that's also what we see in the market, obviously, the malls in the middle and the middle lower segment are still struggling a bit. They have lost a lot of tenants during COVID and are struggling to get the tenancy mix back on their feet. In terms of occupancy, it has been stable relatively since COVID. New supply, though, will influence the occupancy rate towards the end of 2023. So there's some new supply coming onto the market. And so the average occupancy will go down slightly. Like I said, rental activities are still dominated by F&B, also the fashion sector. And we see that electronics and entertainment mainly, I would say, are gaining confidence and are expanding aggressively again. Next slide, please. Now, for the rent, the average rent in Jakarta is about 563,000 per square meter. Again, this is an average over all the different mall grades. In the Bodetabek area, it's about 370,000 per square meter per month. We expect the rents to go up slightly in the coming months towards the end of the year. This is mainly due to the top performing malls, I would say. They have sacrificed a little bit and have been flexible during the COVID period. And because they're performing so well right now, we expect them to increase the rent with a maximum of about 10%. The malls in the middle and the middle low segments are a bit more flexible right now because, like I said, they try to get tenants into their malls, and so they offer lower rents on average, and hence the average increase in rent is expected towards the end of the year. Next slide. Now, if you look at service charges, they're relatively stable. In Jakarta, the average right now is 153,000 per square meter per month. In Bodetabek, it's lower, of course. It's 180,000 per square meter per month. Some malls are beginning to divide larger spaces, and I will talk about that later a little bit more, into smaller size units to optimize the rental and service charge income, obviously. Going forward, the service charges in both Jakarta and Bodetabek are relatively stable. Next slide. Yeah, here you see the dots on both Jakarta and in the Bodetabek area are the averages per mall grade. But of course, some malls are charging higher service charges than others. So you see in premium malls, it's somewhere between 190,000 and 219,000 with an average of 230,000 per square meter per month in Jakarta. If we look at the middle upper malls in the Bodetabek area, there's less supply there, obviously, and also the spread of the service charge there isn't there, so they basically charge similar service charges. So here on this slide, you can basically see the spread that we have and the averages in both areas. Next slide, please. Now we get a lot of questions, mainly from retailers, on the service charge. Obviously, they have to pay a lot of money per square meter each month for the service charge, and so we receive questions on what that money is used for. And we basically took a sample of middle upper malls with an average of 90% occupancy, and this is basically the result where that service charge money is allocated to. Obviously, these percentages are not fixed. They differ for each for different assets, but this is on average where the money goes to. Now, 45% of the service charge income is allocated to people, insurance, legal, and license costs. So that those are salaries, benefits, insurance, office expenses, legal costs, etc. 20% of the service charge goes to utility expenses. You can imagine malls use a lot of energy compared to other type of assets. That's really because of the common areas. There's large atriums generally, and so that costs a lot of energy. Of the 20% that you see here, 90% is going to electricity, and of that 90%, about 60% is going to AC costs, so air conditioning. 13% is going to security. 10% to housekeeping, so those are service fees, garbage, pest control, stuff, toilet accessories, etc. Another 10% goes to repair and maintenance, and about 2%, so a relatively small percentage, goes to marketing and communication. And that's also because most malls charge promotion levies, so that's either a lump sum per year or a fixed price per square meter per year that retail tenants have to pay to the mall for marketing and communication purposes. Next slide, please. Now, obviously, there's a certain maximum that mall operators and owners can charge to their tenants in service charge. And also there's a maximum that retailers can afford to pay and absorb. And so there's two things that mall operators and owners can do in order to keep the service charge price at an acceptable level. First of all, there's efficiency, and secondly, they have to maximize operational revenue. Now, if you look at efficiency, obviously, like I showed you in the previous slide, about 45% is going to the people that work in the mall. So an effective and small organization is something that owners could look into. Could have a lean organization, and so the cost of the people will slightly go down. They can take initiatives on energy saving. I think a lot of malls are already doing that, but you can imagine malls have peak hours as well. The weekends tend to be much more busy than the weekdays. And if you look at weekdays, the evenings tend to be much more busy than during the day in certain malls. And you could adjust your AC system and the temperature in the mall so that energy use is reduced in non-peak hours, basically. You could have also invest in more energy efficient AC systems if possible. You could also invest in systems in the toilets, for example, that reduce water consumption. And then, of course, there are certain programs and applications available in the market that can help you to reduce your overall costs, but especially your energy costs while operating your mall. And then obviously, you have to maximize your operational revenue, and that can be done by parking, exhibitions that tend to generate a lot of revenue, just like casual leasing. And there's all sorts of possibilities in and around the mall for advertising and billboards. The lease of public spaces in and around the mall, and antenna rental. Those are all options that mall owners have to increase their revenue, which can be used to lower the service charges that they charge to their tenants. Next slide, please. Certain considerations for developers. The ratio of common areas and leased areas. We say at least it should be 50-50, meaning you should have 50% of your mall space should be leasable, and the other 50% common areas. A better ratio would be 60-40, obviously, because you want to maximize your rental and your service charge income. The tenant mix composition, always owners are looking at the right balance of the amount of anchor and mini anchors in the mall. Those are of course, the retailers that attract, to pull in the crowds, but the ratio should be in balance, because generally anchors pay less rent, obviously, but also less service charge. And you want to have the right balance of specialty stores, smaller units, who pay the highest rents and the highest service charge to the malls. Like I said, F&B tenants and entertainment are still dominating right now, and are attractive options for shopping malls to bring them in and attract consumers to your mall. And then I also mentioned it already, the air conditioning system and energy control systems is something that mall owners should look into in order to invest in order to lower your energy costs, which is about 20%, 25% of your overall operational costs. Next slide. Some trends, and again, we're looking at the service charges here. The service charge is projected to increase in 2024. It will most likely follow the inflation rate. Also, your employer cost salaries are an important factor there, as it is about 45% of your total operational costs. Increased salaries will obviously influence the service charge. The average increase in service charge in 2024 is expected to be around 3%. Even if there will be an increase in service charge for the remaining of this year, it will not exceed that 3%. And on average, the increase will occur in shopping malls with good performance. Same with the rents. We expect malls, high-performing malls, to increase the rent a little bit. We also expect those malls to do the same for the service charge. I think that wraps up my presentation. If you want more details on the service charge, we have those available. This is a general overview that we prepared for today, but we have more details on it. So please reach out to me if you would like to have those. Thank you.
Thank you, Sander. We're moving on to the next sector, which is industrial and logistics. With us today is Bapak Rivan Munansa, our experts in the industrial and logistics sector. And Pak Rivan will share his valuable contributions and property market information on industrial and logistics. Over to you, Pak Rivan.
Okay, thank you, Auntie. Good afternoon, everybody. Here is the update of the latest industrial market. You see from the chart. So far, the remaining available land for industrial development is predominantly located in Karawang in the eastern and Serang in the western region. This development aligns with the establishment of the port in Serang, Bojonegara, as well as Patimban port in Subang, which has also influenced the direction of industrial development in those areas. The industry is completely different between west and east, as we know that the west area is more for the chemical and heavy type of industry, while the eastern region is of Greater Jakarta has indeed become preferred location for more on the high-tech industrials, automotive, non-polluted industries. So then there is a high demand for such industry in the east, which is leading to, as you can see, a limited land supply, especially in Bekasi, is getting less and less. And consequently, this has triggered industrial growth in Karawang and is currently actually extending further eastward into Purwakarta and Subang area. Next. Okay, if you see the chart, is actually this is the last quarter. As we see from the chart, on the second quarter of 2023, only a few industrial areas recorded transaction, with just in this case is only 6 industrial estates being involved. However, this area achieved significant sales figures, contributing to an overall improvement in sales performance. During this quarter, as you can see, GIIC once again is leading consistently by selling highest amount of land. Primarily, maybe on the next slide, we can see that driven by the sales of the data center companies, while they also have like more smaller plots were sold to an automotive companies. Meanwhile, Jababeka also sold multiple land to multiple companies, including factories such as plastic or electronics sectors in. And the number 3 is Arta Hill, which is related to more on the textile industry. Okay, next. Okay, if you see from the charts, we can see the total sales from each industrial estates during first half of 2023. It's still, in total, it's actually still less compared to the peak era, which is on the 2010 to 2014. Yeah. But we still believe that this sales is actually positive toward the end of the year. Okay, next. As you can see from the charts, that the leading one is actually the data center, followed by manufacturing, different type of manufacturing, and then the third one is automotive. So still, if we see that, you know, the data center is actually contributes most of the sales of the industrial. Next. Okay, if you see the chart from 2006 to now, as the peaking era is 2010 and 2014, actually until the first half of this year, the total sales of industrial land have not yet reached 50% of the total sales for the entire year 2022. However, based on the sales pattern observed so far, it is typical for sales in the second half of each year to be higher than in the first half. Additionally, some industrial areas have recorded pent-up demand indicated by several potential clients who have initiated negotiation process already. Although we see the challenges for the second half of the year, especially surpassing the sales of the first half, but we are still confident and positive that the trend will continue to go up until the year of 2024. Next. As for the rental, as you can, regarding the price, sorry, not the rental, the price, the land price, this year, we indicate that 4 industrial estates have started offering their land price with higher asking price. And the ranging of the increased asking price is about 5% to 10%. But it is important to note that only those industrial estates that have consistently recorded sales growth have raised their land prices, while the others have maintained their previous prices as they are primarily focused on achieving their targeted sales volume. However, at the end, we still believe that the final transaction may remain stable in general. Okay, next. So talking about the mapping, here's the mapping of the updated landscape and anticipating future development. We see the corridor from Tanjung Priok to Patimban will be an attractive corridor for the investor. Currently, we realize that there is a demand, high demand from the electric vehicle industry, in which they are trying to explore the investment opportunity in Indonesia. This includes the electric battery industry as well, which will support the EV industry. So we learn from the situation that actually the EV component still mainly will come through Tanjung Priok port, but in the once they invest here, when they establish the factory, then the finished product will go, you know, either to Tanjung Priok, or if the Patimban is already developed, then potentially will go through Patimban. port in the future. And as we know that Patimban is designated location for local market, but as well as for export oriented product. Okay, next. And as you can see that the potential new land supply are mainly located along the second jor, which is will be completed from Cibitung to Marunda area, as well as in Purwakarta area and stretching toward Subang area and going up north to the Patimban port. These are the potential, and we have seen that a lot of landowner is already start preparing their land in anticipation of the EV industry that will develop soon in the future. Okay, next. Okay, recently we have seen a potential factory setting up, which is recently mainly we see a lot of Chinese companies. They are currently exploring the availability of industrial land and properties. And majority of them prefer to lease existing buildings for a duration of 3 to 5 years. We understand that they would like to study about the market. They would like to know about the investment condition in Indonesia. Once they are sure about the market, then after the lease, they will start investing in Indonesia. And based on our experience, the most preferred areas will be Jabodetabek, Semarang, and Surabaya area. Okay, next. So what the trends right now? We see that a lot of factories, a lot of companies are readjusting their condition to the pre-pandemic conditions because of the behavior of the buyer. So some of them in terms of the sales going back to the pre-COVID condition, especially if you see also like the next one, which is e-commerce. Since there is a significant increase during the pandemic, now they are readjusting, in which they start now trying to consolidate all their business in order to have a cost saving on their operation. And then we see also there is a trend that the new data center is not like a hyperscale, which is they go outside the city, which is majority of the hyperscale data center already going into the market. We see the trend that the new data centers, they're looking actually the other way around, which is they would like to be in the city, in the urban areas. And then the last one is we see that also all the especially multinational companies, they start also thinking of growing their business toward automation, in which to have more efficient on their operation, and then at the end is actually a saving costs and increase profitability. That's my guess. Wrap up my presentation from industrial. I give it back to Anti. Thank you.
Thank you, Pak Rivan. Moving on to the next sector, which is apartment market. We will have Pak Steve Atherton with us today explaining about the apartment market. Over to you, Pak Steve.
Thank you, Auntie. Okay, hello again. For the apartment market, to put it bluntly, there is not a lot of fresh, encouraging stories to share about the current apartment market in Greater Jakarta. All categories of apartments and pricing, low, middle, upper, luxury, are all affected by the current turmoil. The slowing apartment sales did not start in the COVID period. It was already well underway as far back as 2015. We saw total apartment absorption in 2015 of around 10,000 to 11,000 units. Since then, annual absorption has continued to drop year on year to the point where we only had plus or minus 1,389 units absorbed in 2022. So far, 2023 is not reflecting any major change in the situation. At the end of Q1, we had 486 units absorbed, and by the end of Q2 2023, we had 670 units absorbed. The rest of the year will likely remain challenging too, as investors remain on the sidelines, and we have the next major election season coming upon us with elections in February of 2024. You can see the absorption story on this slide on the left upper portion of the screen. You can see absorption from 2016 to year to date 2023. It's a downward trending progression. And then you can see the take-up rates in the lower left corner of strata title apartment projects. The existing projects are pretty well taken up, but under construction projects aren't doing as well as we have seen historically. In the upper right corner, you can see the average price per square meter for different geographic areas like CBD at the highest price per square meter, South Jakarta, and then non-prime areas. So currently, existing apartment projects are more favored and predominantly sought by end users. And we are expecting demand to remain stable in tandem with infrastructure developments. Next slide, please. So developers are emphasizing the completion of pending projects. We're not seeing much in the way of new land acquisitions and launching of newly planned apartment projects. Next slide, please. If there's any promising sector within apartments at the present moment, it would be the service department sector. In Q1 2023, we are seeing occupancies rise back to 63.2% versus a point lower in Q1 2022. And in the CBD, we also see rents back to 441,000 per square meter per month, compared to Q1 2022, which was 392,000 per month in the CBD. This successful performance rides on the back of the Indonesian economy doing well, and mostly foreign tenants seeking quality buildings and services which are located convenient to their workplace. Also, the service apartment owners have the added advantage of secure long-term rentals from traditional tenants like embassies and corporates, as well as the ability to offer short-term rentals like a hotel for a certain component of their room keys. It's a flexible product that commands one of the highest rental rates per square meter of all asset classes. So I think the slides are self-explanatory. You can see the occupancy rates and how they've moved on the upper left side from 2021 through 2023. And then you can also see the rental tariffs and their movements on the upper right-hand side. Next slide, please. With the, I think we've covered the apartment service apartments, so we can move on to the next slide. With the apartment market typically made up of 60% investors and 40% end users, we are definitely seeing that an increasing proportion of the current demand is from end users. Next slide. In fact, in Q2 2023, the proportion of end user buyers has increased from the norm of 40% to 54%. The hope for the future apartment market demand is that some contingency of the end users will no longer be willing to buy affordably priced landed houses that require 1 to 2 hour commutes in each direction every day. And they will start more about lifestyle, convenience, and affordability in the apartment sector. And for the middle luxury market, the apartment market should be attractive to older people seeking to sell their landed houses, downsize, and simplify their lives, or successful professionals and young families seeking convenience to the workplace and proximity to the schools where their kids attend. Also, let's not forget how popular apartment living is still today in compact housing markets like Singapore, Hong Kong, Seoul, Tokyo, and Tier 1 cities in China. We don't think Indonesians will forever buck this regional trend, but we still have some headwinds ahead of us. Also, in comparison to other markets nearby, like Singapore, next slide, please. Jakarta looks very attractive when you compare the acquisition cost or the rental cost per square meter. And with the recent increase in stamp duty for foreign buyers in Singapore, going from 30% to 60% of the purchase price, as well as the huge rent increases in apartment rents in Singapore, ranging from 10 to 20%, as high as 100% increases. Who knows, maybe we will start to become attractive as an alternative regional headquarters for companies or individuals who are starting to get priced out of the very expensive Singapore market. If it offers any kind of relief or comfort to apartment developers and owners in Jakarta, I would like to briefly share some of the background about what's happening in the US multifamily or rental apartment. With the Great Recession of 2008 and 2009 in the US, it took 7 quarters for the rental apartment market to hit its prior peak by mid-2011. Since 2011, the US rental apartment market has been on a steady rise. Fast forward to today, and the rental apartment sector is facing a wall of loan maturities in a market environment that is very unfavorable for refinance. In October alone, well over $4 billion in commercial mortgage-backed securities associated with rental apartments will come due, and November's total will be nearly $4 billion as well. Those totals don't count the non-CMBS loans, so the actual total will be even higher than those figures. For high-quality assets in good locations and for the operator that has a good relationship with their lender, there's a reasonable chance that something can be worked out. But for a marginal asset, a marginal borrower may not have nearly as many choices, if any. In Q4 2023, the wall of debt maturity is a result of the peak in rental apartment investment sales that happened exactly 2 years ago. Interest rates were at historically low rates then, while demand for apartments and the rents they command were heading higher and higher. A lot of buyers were inspired by the fear of missing out. Investment sales in the apartment sector peaked at over $115 billion in Q4 2021. Now that the interest rates are higher than they have been in recent memory, many of those borrowers face a difficult choice: either sell their property soon or try to refinance and be forced to bring more cash to the table to avoid default or foreclosure, often as much as 15% to 50% of the original equity contribution. For lower quality assets, the situation's even worse. Not many are predicting that interest rates will decline this year, thus incentivizing rental apartment borrowers with maturing bridge loans or floating rate loans to sell their properties. However, like any forced sale, there will be downward pressure on prices. Strangely, the wall of debt maturity is coming at a time when demand for rental apartments is still strong and rents are still historically high. All in all, it's a complete mess. Demand for rental apartments is surprisingly strong now in the US, but the financial realities of how these assets were financed just ahead of a sudden and rapid increase in interest rates has created this upside down situation. So in closing, sometimes it helps to see the dire challenges of other markets to feel a little better about the short-term difficulties of our own markets. That completes this discussion of the apartment market. Thank you.
Thank you, Pak Steve, for the explanation on the apartment market. Now we're moving on to the last but not the least sector of today's session, which is expatriate housing. Already here with us, Ibu Lenny van Es-sinaga as the head
Hello.
of residential services, expatriate housing in Colliers Indonesia. Mbak Lenny, over to you.
Okay, Auntie, thank you. Okay, so for housing market, expatriate housing market, the update that I can share with you, very good news, very positive. So in this slide, I put that the expat mobility returned back to normal, yeah, and a lot of expats coming since like mid last year. And still that's not Jakarta, that's favorite because that the expat living area, whereas that international schools, you know, that the facilities and everything. And we'll see that in the market, that's the companies prefer that their expatriate that living in the complex, you know, that like right now the high demand properties like Executive Paradise Complex, Lembong House, you know, Atmaya Residence, and that's some big landlords. So we'll see also that the waiting list in the some of the believe it or not, that in the high demand properties, and quite interesting, you know, that they're still prefer that their expatriate that moving to those high demand properties. And then we'll also see that the landlords that still, you know, that they are adapting with the changes in the company cultures. So still that the minimum 1 to 2 year lease in the market until now. And the condition that dominated that many expats, the companies prefer to renew the contracts and that in their those properties. So they're what you call that, they're trying to not get that the expat moving to the new properties. So this is that the demand that keep continue increasing in the endemic pace. Next, please. Okay, these slides, we'll see that the companies beginning to resume the operation, and then the expatriate market also shifted to the landlords market, and then starting to foster to believe that the companies can resume operation as they did before. And then we also seen that the more control management of the pandemic instill increased confidence in the company, allowing them to gradually send expatriates back to Indonesia. And then also we've seen that the placement of expatriates in Indonesia displaying a positive trend, resulting in a noticeable surge in the housing demand. Next slide, please. In this slide, I put the lease and the payment terms and personal contract. So in here, landed housing rents and payment terms are reverting to pre-pandemic levels. And then the indicated also to return to the normalcy for the landlords. And then another point that I put here highlights that the landed housing rents have increased. I can say that not more than the 15% from pre-pandemic levels. And the lease term still the same for landed housing. a minimum of 2 years with the full payment in advance. And for the apartment, is more flexible with the minimum 1 year, depends on if there's apartment, the high demand apartments or not, and still full payment in advance. And then also in here, some companies, I'd like to highlight also since last year, I think that's the last couple of years, they prefer to have expatriate to use their personal contract. So the reason probably that I can say that flexibility, cost saving, and then also the employee satisfaction, and then another factor also the taxes, why the companies prefer expatriate to use personal contract, maybe that I can say that tax implication, and then tax equalization, because some companies have the tax equalization policies in place for the expatriate employees. So sometimes under their policy, the company ensures that expatriate tax liability remains the same as they were still residing in their home country. So the company provides housing under, if they provide the housing under company contract, it may be considered taxable benefits for the expatriates, potentially increasing their tax liability. So using personal contracts maybe allows the expats to manage their housing arrangement independently, potentially avoiding tax implication. Next slide, please. Okay, in here, in this slide, landlord's flexibility has changed over the years. So most landlords now agree on the direct 1 or more year lease extension. And then that surpasses anything seen in the market just a few years ago. And then, that without monthly option, so most landlord owners opted for 1 year or more lease extension without monthly options, in contrast to the practices during the pandemic. So the landlords or owners have become less flexible when it comes to accommodating the wish list provided by prospective tenants. That's why that, like I mentioned earlier, that's the incoming expats coming that we've seen in the market, a lot of projects also that what we are in residential, that what we are handling, also that the new expats coming, surprisingly that the company also that give that a good budget to the expatriates, so to make sure that they comfortable, and then even they're not coming with the family, I mean, not all that coming with the family, mostly that the couple or the singles, but this is the things that is different than the pandemic time. So the landlords know about those kind of things, and then they're more not flexible to for the lease term or the prices. So the time frame that given the landlord to the prospective tenant to make decision also significantly shortened, often allowing only a few days to respond. So let's say like like I mentioned also about the waiting list and the high demand properties. So they really like that the landlords to make sure that they got the new tenants to decide as soon as possible, with the good lease term and then the good price. Next slide, please. Okay, so in this slide, I put that the trends, few trends in here that we've seen in the market, in the residential. So tenants prefer to move rather than renew their lease. Okay, so because that the rental that increased, that slightly increased, like about not more than 15%. I think that's 5 to 15%. So some companies that prefer that their expatriate, that because over the budget, they move to the new property. So that's what we experienced in the residential. They move to the smaller house, like a townhouse or the standalone house, smaller. And then they also some clients that choose the apartments, just to make sure that their budget fit, no need to spend more than their budget. And then also we've seen here the trends that we recommend the expatriate considering leasing for 2 years in advance, because that some companies think that is still like a pandemic time, so they can also they can lease that for 1 year. But the market changed, the landlord's market now. So we mentioned to our clients, to the companies, like, you have to it's better to rent that for 2 years, you get the better price, and then also that the landlord is willing to make changes on the wish list. And then the next, the high demand complex house availability is limited due to the company's recommendation, because most of the companies that we handling, that they prefer that their expat that living in the complex, with the facilities that it's very convenient, gated complex. So they not spend that the money for the security, and then of course the safety of the families, that's still top priority for the expatriates. And then the last thing that what we've seen in the market right now, the trends that the companies prefer that the properties that furnish condition, for the landed houses. For the apartment, of course, that mostly that coming with the furniture, so furnished. But normally that before that for the landed houses, the condition that unfurnished, so the owner only provide that white goods. But we've seen that since that last year, what we handling now, the projects, and then the exclusive clients, they prefer that the property is furnished. So the owners should provide with the furniture, or that rental the furniture, so because they don't want to spend also for the shipment, because it's costly, right? So that's why that we're talking to the owner to make sure that they can provide some fully furnished houses. Okay, I think that's all from me. If you have any question and need assistance from the residential team, so please do not hesitate to contact me. Thank you. Back to you, Auntie.
Thank you, Lenny. Ibu Lenny's presentation wrap up our session for today. However, we still have a question and answer session. But due to time constraint, I will only probably ask one question per sector, and because we received quite a lot of questions today and prior from today when the registrants fill out the forms. So for those of you who already raised your questions but do not get answered today, our team will get back to you through email with the answers from our experts. So don't worry, we will still answer your question via email. Let's get to our first question for Ibu Monica and Pak Steve Atherton in terms of IKN, Ibu, the new capital city. Bapak Luki Arisandi raised a question. Have you done any preliminary study on the impact of relocation of capital city? Understand it will be gradual, so appreciate if you can also give your view on both the short and long term to each of the retail each of the property sector, and have we been consulted by the government on how it plans to use its current existing buildings in Jakarta? Pak Steve or Ibu Monica?
Okay, I think I will start first.
Yes.
Thank you for the question. We haven't done any preliminary study on the impact, so the formal study for this one, we haven't done it. However, we have analyzed in brief internally about this relocation of capital city to Nusantara. From our point of view, when we talk about this relocation, we have to see from 2 points of view, from Nusantara itself and from Jakarta. From Nusantara point of view, it will have a positive impact, or maybe in Kalimantan, yeah, because demand for property will be increased with the operation of the new capital city, with all the government institutions and others, because nothing happened there in Nusantara now. So demand will be increased quite significantly. In Jakarta itself, we have to categorize into short term and long term. In short term, we see that maybe the impact will not be coming in short term. Why? Because first, we have to see the policy itself. Because until now, yeah, there will be a plan for that, but for how many people and when, the timing and others. So maybe in the short term, the impact for property in Jakarta will not be quite significantly impact. Besides, Jakarta itself still become the focus for business. So commercial activity will still focus in Jakarta. So demand for property are still there. Maybe in the long term, when this realization of Nusantara will take place, maybe there will be some decreasing in demand. Why? Because young people are going there, and these young people are usually major market for housing, for retail, and others. So this is actually the impact. And whether we have been consulted by the government, until now, not yet, because they are still also not confirmed on what to do with the current existing buildings in Jakarta. That's my answer, Auntie.
Thank you, Ibu. Pak Steve, do you have anything to add?
Not much. The only thing I would add to that is we have seen some of the major developers jump in to announce projects there, like Ciputra recently announced a housing, I think, hotel and golf project at Nusantara, and Pakuan also announced like an apartment mixed use with mall and hotel. So it is good to see some of the big players backing Nusantara and providing some of those initial mixed use and housing and hotel golf type developments. So that's a positive. I haven't seen a lot of other private investors, especially foreigners, yet really dig in and make commitments. I think they're still more on the wait and see mode. And the other point I would make is if all of the government offices slowly but surely move to Nusantara, I think one impact that you have to look at closely is the MICE market in Jakarta and Greater Jakarta that depends so heavily on government employees using their facilities for MICE. It'll be interesting to see how the hotels make the adjustment for that.
Okay, thank you, Pak Steve.
Thank you.
We're going to move to our next sector, which is office, Pak Bagus. We have a question from Pak Aga Ganesa. Green building is mandatory, but how to do it? I think it's still unclear by the government. Is it? I assume this is for office.
Yeah, thank you,
Bagus,
Auntie.
yes.
Yeah, thank you for the question, Pak Aga. The mandatory for companies looking to consider having their office in a green certified building is actually triggered by the companies, triggered by the occupiers. So part of the ESG initiative, more and more companies basically have instructed their companies globally that if they are going to move to or open branches in different countries, they must take a certified green buildings. Unfortunately, in Indonesia, is this not yet supported fully by the government. There is discussion within the government about the requirement for sustainability to be green and all those discussion. However, until now, it is not yet concrete on the reason. Now, because of those requirements driven by the occupiers, makes landlord here in Jakarta, in order to be able to secure their tenancies, they're changing their buildings and apply for the green certified buildings, which can be done, and then the certification could be done by Indonesia itself and could be done by Singapore. So that's like the two common certification of green buildings. Indonesia is by Green Building Council Indonesia, and Singapore by Green Mark. So I hope that answer your question, Pak Aga. Is driven and triggered by the occupiers, not but the government of Indonesia is still doesn't have a concrete plan towards that yet until now.
Yeah. Thank you, Pak Bagus. And I think to add to that, Pak Bagus, Colliers Indonesia also provide a consultancy for occupiers who would like to have a certification in green building. We have our facilities management team who actually do that. Next question for Pak Bagus, still for Pak Bagus. It's for Ibu Stephanie Hidayat. Do you foresee the potential increase in office sector in 2026 as an increased occupancy alongside with the rental rate, or just a pickup in occupancy that will fill up the huge unoccupied space that we still have?
In 2026, the reason I feel that I believe that the office market will start to turn around is, as I mentioned early on, right? So it's oversupply right now. Supply limited. It's going to be limited while demand is growing, because after the COVID, we recorded GDP growth of steady of 5%. And as I mentioned previously in many webinars, that the correlation is very strong between demand for office space and the GDP growth. So we don't foresee any new development or new supply coming in the market in 2026. But demand continue to grow. So that's we believe is gonna come back, and then the result of the coming back is more like into the occupancy. For the time being, because the carryover of the vacancy is gonna still continue, right? From 2004, 2025, 2026. But as the demand is growing higher than the supply, it's gonna catch up. And then once the occupancy rate is going above 80%, then the rental rates will pick up parallelly. After reaching those average occupancy rate of 80%, which is pretty much prior to the pandemic levels. I hope that answered the question to Ibu Stephanie.
Thank you, Pak Bagus. We're going to move to the next sector, which is retail. Sander, okay. Bapak Kazim Ali Bokhari raised a question. How about the average rental increment in base rent in upscale and premium malls in Jakarta? Are there any other markets with good spending power from consumers out there besides Jabodetabek, Sander?
Okay, Pak Karim, yeah?
Yes, Pak Karim.
I think,
Pak Kazim, sorry.
Kazim, I think the average rental increment, usually in malls, retailers sign for specialty stores, they sign for 3 to 5 years. So the base rent increment is usually done after, let's say, the 3 years is done and they want to expand. Both the mall and the retailer want to expand. Basically, that's when the mall owner is going to do an offer, and then there's a difference between the offer and obviously the price that the retailer signs for. I think for premium malls, probably the offer is 20 to 30% higher than the rent that they're paying at that moment in the initial contract. And then the transacted rent is somewhere between 10 to 15% higher, I would say. That's for the base rent in premium malls. And then for consumers with spending power outside of Jakarta, I think the main city that I would say is Surabaya, where there's a lot of spending power among consumers. But there's obviously other cities with, every city has more wealthy people than others, but I think Surabaya after Jakarta is probably the second. I hope that answers the question.
Thank you, Sander. We're moving to the next sector, which is industrial and logistics. Pak Rivan, another question from Pak Kazim. Please share, in your opinion, what economic sectors or industries are unlikely to grow in the next 5 to 10 years that will absorb the upcoming land supply or industrial building supply?
Okay, thank you, Auntie. To answer Pak Kazim about our opinion, as you see in my presentation, that you have seen that electric vehicle is the one that will take most of the land in the future, the development. Because if you see the history of the picking up, which is during 2010 and 2014, is actually mainly is because of the automotive industry. And then when we are talking about the EV industry, it's not only the automotive, but as well as the electric battery, which is that's also will related to the upstream business of the EV battery. So this will trigger all the requirement as well as all the vendors and related to the automotive, because EV is like a new type of industry that just enter into the Indonesia market, So I think that's potentially will eat the anchor of all the future supply, in which, as I explained, is in between the which is stretching now from Karawang to Purwakarta and as well as to up to Patimban. And then the other one that I see that will continue grow in the 5 to 10 years will be consumer goods, because we have seen a steady growth in these industries, even though the size of the requirement of the industry is not as big as EV, because EV we are talking about 60, 80 hectares, 100 hectares, but the consumer goods usually start with 5, goes to 10, can be up to like 20 or 25 hectares of land. So in our opinion, these are the two like key potential that will take up the demand, the supply in the future for industrial land. Yeah, I think hope that is clear to Pak Kazim. Thank you.
Thank you, Pak Rivan. Last question for today before we wrap up our session. It's to Pak Steve Atherton, and this is for apartment market, Pak Steve. Ibu Susan Lasmono raised a question. Would like to know the condition of the low-rise or mid-rise apartment, the 4 to 5 floors, the 4 to 5 floors type apartment, Pak Steve.
Okay, thank you, Auntie. This is a very interesting question. It's come up recently with some foreign clients that are studying the Jakarta and Greater Jakarta apartment market. As they go out and they meet potential landowner and developer partners that are proposing vertical projects, more of the mid to high-rise projects, it's really difficult to see any anecdotal evidence of really healthy take-up absorption of apartment projects, since about COVID time to present day. So the next area that they're interested to explore is the idea of a low-rise apartment opportunity, and is that a product that would resonate with buyers, end users, and investors? So this is something testing out. We don't have any final answers to that yet, but we're testing markets like in Tangerang and Depok and fringe areas, basically where the land cost is not so high, because you're not going to get a good economic outcome for low-rise, lower density apartment projects if the land cost is really high. You need to find a marketplace where the land cost is more reasonable and you don't need the high plot ratio, high density to achieve good returns. But you've seen some projects like Sumerican has some low-rise product. I think I've seen in Kelapa Gading. Alam Sutra has a low-rise product in Alam Sutra that I think was quite interesting and successful, 4 to 6 floors. So I think you're on the right track with that question. It's a product type, I think, whose time has just about arrived. Thank you.
Thank you, Pak Steve. That was the last question that wrap up today's webinar. Thank you for everyone who's already joined the session, and thank you for our experts for the presentation today. If you need to talk or to discuss any property inquiries with our experts, you can see in your screen QR codes to contact them. You can just scan and save their number or contact them directly. And do not forget, we just released our latest publication, Colliers Quarterly, for the second quarter of 2023, and you can scan the barcode here to download our reports. Finally, thank you everyone for joining and for your time. We'll see you again probably in January 2024. Until then, stay healthy and stay safe. Bye-bye, everyone.
Bye, everyone.
Bye.
Bye.
Bye-bye. Thank you.
Thank you, everyone.